All right, guys. Joe Saglimbeni on his YouTube channel, Joe Saglimbeni, and his live stream. Let's chat live. And today, it's Saturday, March 27th, and we're going to talk about mutual funds versus stocks. All right, maybe I'll go into some examples and stuff like that, but that's what we're going to talk about today on today's live stream. So first, let me introduce myself. I'm Joe Saglimbeni as I fix this camera. Um, Investor, blue collar worker, investor for the last 3 decades, and I invest in stocks, mutual funds, cryptos, real estate, and here on my channel we talk about all different things like growing on YouTube, stocks, cryptos, reviews, unboxing, a whole kaleidoscope of stuff that we talk about. It's a crazy channel with all different subjects. And today I thought for today's live stream, which we try to do a live stream every Saturday here on my channel, and I try to do as many as I can every Saturday. I try to schedule it. I try to get in the morning, but sometimes I'm just too busy in my everyday life. But subscribe to the channel, hit that bell for notifications, and you'll get notified of the videos and live streams. And just watch for it on Saturday. Today it's a little late, but my goal is to at least get a live stream every Saturday. All right, no matter what time it is. It could be in the morning, it could be in the afternoon, and one of these days I'll get it the right time. But today I want to talk about mutual funds versus stocks. So if anyone's been paying attention to my channel or have followed me on my blog, accessnotdenied.com, I have been investing for over 3 decades, going back to the famous October 1987 crash, back in 1987, of course. And I was in college back then, and that's when I started getting interested in the stock market. But of course, I started buying mutual funds in the beginning because I was relatively young, 18 years old, and I never really knew anything about individual securities. I knew there was something called mutual funds. So I started investing in Franklin mutual funds from the Franklin Templeton Company. And these mutual funds, they were interesting. They went up. And during the 80s and 90s, you had a good run. And I learned a lot about them, but I didn't know about the fees at the time of mutual funds. And those funds from Franklin Templeton had high load fees. And I eventually learned this and started investing in low fee cost funds from Fidelity and Vanguard and individual securities. So here's the thing. Before I get into any of this is my opinion. I am not a financial advisor. So please do your due diligence and reach out to a financial professional about anything I talk about here. This is just me giving you my life experiences and opinions on these products or stocks or mutual funds. All right. So now that we have that disclaimer out of the way, there are many low load or no load families like Fidelity and Vanguard, which have mutual funds. And basically what a mutual fund is these companies will have someone run a whole pool of investors' money, and they'll invest in the stock market. They could buy 500 stocks, 700 stocks, 1,000 stocks. There's also index mutual funds, which follow the indexes like the S&P 500 or the Dow Jones or the Wilshire 5000. or the NASDAQ. And those are how a lot of people invest. They use index funds. Now, in my company, I have choices of index funds. In the company that I work for, I have choices of index funds. And in my 401k, so a lot of times I've picked the index funds and I just dollar cost average. And dollar cost averaging is basically putting money to work every week into an asset like a stock or a mutual fund. So when my paycheck, out of my paycheck, the company takes out money and puts it towards the 401k into mutual funds. Most of my mutual funds in my 401k, and many 401ks have mutual funds that are tied to indexes like the S&P 500 or the total stock market. So a lot of those funds in the 401k, the mutual funds, they just basically dollar cost average into the overall market. And that's something that anyone can do even outside of a 401k by going to one of these companies like Vanguard, Fidelity, T. Rowe Price. A lot of these are no load or low load mutual funds, very low fee. And index funds are very low in fee, like stuff like the S&P 500 or the total stock market index. Now, what do I think about mutual funds? I think mutual funds are great. Hey, Tectonic, how you doing, man? Thanks. I think mutual funds are great for people who don't want to analyze stocks or individual securities. They could pick an index fund or a growth fund, dollar cost average that over time, and they should at least match the market. And historically, the market, the S&P 500, does around 8 to 10% per year. Historically, now you could have a decade, a lost decade, where it doesn't go anywhere, but you'll get dividends uh, reinvested with these mutual funds. And you can also pick certain sectors or types of stock mutual funds, like something like a small cap mutual fund or small cap index. So I always recommend to people who want to start in the market by starting with an index fund, something like the S&P 500 or the total stock market index fund. And Fidelity and Vanguard and Charles Schwab and T. Rowe Price all have these index funds. But this live stream is about mutual funds versus stocks. So in the history of my investing, I would say 60 to 70% of my overall portfolio is individual stocks. Now, I analyze these stocks on my own, and it takes me a long process of analyzing them. And I like investing in individual companies because individual companies have a good chance of outperforming almost any mutual fund. Now, what I mean by that is you may invest in a index fund, something like the total stock market index fund, and you might get 10% a year, which is a great return, annual return a year on average. That's a great return. But if you see on one of my videos, and maybe I'll show the video when this goes, I'll link it down here or up here, about how I beat the S&P 500 for the last decade, 20% per year. I did it with individual securities. Now, I'm not saying that's possible for anyone to do, because it's very difficult. You have to know what you're doing, and you have to analyze these stocks, and it takes work. It's like another job. So I always recommend people just invest in mutual funds. Now, let's say you do want to capture the tech world of Google, Microsoft, Facebook, or Apple, or something like that. You can get a mutual fund that's tied to that sector. Maybe a tech mutual fund or a tech growth fund, and you can play or invest in that sector, including Google, Microsoft, Apple, and other companies through the mutual fund. Now, why do I think that individual securities, a basket of individual securities that I select myself, can beat out a mutual fund? Well, it's really simple. And this is why Warren Buffett, the great investor Warren Buffett, actually most of the time beats the indexes. It's because when you expand that pool of stocks, so for example, a mutual fund will buy 1,000 stocks, and they could be GM, Ford, Google, Microsoft, IBM, Verizon, AT&T, Target, and a whole bunch of other companies. And here's the thing, when you buy that big of a basket, you kind of dilute your returns. You kind of lower your returns compared to someone like me who's only buying a basket of 30 individual securities that I've done a deep analysis of. So it's very difficult sometimes to beat an individual investor who invests in a smaller basket of 30 individual stocks. Now, on the downturns, an investor like me or Warren Buffett will get hit harder because that basket is smaller. And when the overall stock market falls, maybe the overall stock market falls 15%, chances are my individual securities have fallen 20, 25, 30%. I'm taking that risk of I'm taking the bad risk too, the risk of the stocks falling heavier than an index. So that's why I can outperform the index, or anyone can outperform not anyone, not even me. You have to do a deep analysis and get 20 or 30 pristine growth companies, and you most likely would beat the indexes or a mutual fund. But that's just the indexes, like the S&P 500 or the total stock market index. But there are mutual funds that can give better returns than the indexes. And I know you hear it that most people lose out to the market. Most mutual fund people who run mutual funds can't beat the overall market. That's really not true. And all you really need to do is do your homework. So you take example Fidelity. Let's say you joined Fidelity and you have a brokerage account with Fidelity, and you look up a mutual fund. You can screen for mutual funds using Fidelity's tool, and I'm sure Schwab has the same type of tool. TD Ameritrade has a similar tool. But let's stick to Fidelity because it's the one I know the most. You could screen for returns for the last decade. You can screen for Morningstar rated, high rated funds, and you can screen for the sector like blue chip or tech or real estate or something like that. And then you make your list, you look at the funds, you check out the chart, you check out the analysis of the fund, the 10-year returns, and sometimes you can find mutual funds that are consistently outperforming the indexes. So you don't have to try to find or build a portfolio like I build for myself. There are mutual funds out there that can beat the indexes. You just have to search for it. You have to do your homework. And I don't think it's a mutual fund or a mutual fund versus stocks kind of issue. Though I named this live stream that, I really think that the easiest way to invest in the stock market is through mutual funds and not necessarily through individual securities. At least in my opinion, we're talking about someone who has over almost 4 decades of experience doing this. And I only managed to do 20% per year for the last decade. So I've had some hiccups in there. I should do more, right? If I'm so great. And that's the thing. You're not so great. I am not so great. But I have a fun time and enjoy analyzing equities, individual companies, individual securities, and then putting my money to work with them. But I'm telling you, you don't have to. So in this case, it's an even race. Mutual funds versus stocks. Actually, it's not even an even race. I'd give the advantage to the mutual fund because how much do you value your time? If you just set up a mutual fund, dollar cost average into it every week, every month, every day, every year, it's like having an automatic robot dollar cost averaging into a good, very good fund or a very good fund that has a lot of stocks. You get it's automatic. You don't even have to think about it. You have to worry. You don't have to lose your hair. I mean, look at me. I lost my hair, right? That's a joke. It wasn't because of stocks. But that's the thing, guys. Maybe mutual funds win this battle. Simplicity, consistency, dollar cost averaging, easiness. I mean, the winner is really mutual funds when I come to think about it as I'm doing this live stream live. So that's basically what I wanted to explain. Don't be scared of the market. Invest. Get your feet wet with a mutual fund. Go on one of these sites like Fidelity or Vanguard or T. Rowe Price or Charles Schwab or TD Ameritrade. Join. Put your money to work. Enjoy the process. And you'll end up doing better than the average person. All right, guys. So that's about it today. I wanted to really make this live stream because I know a lot of people have been asking me questions about why can't I just invest in a mutual fund. So that's what I want to do. I wanted to answer those questions. I had a lot of coworkers and friends who've asked me this. Joe, I'm too scared to invest in individual securities. So that's what I did. I wanted to make this live stream to help regular people. All right, guys. So let's end it here and just say share, subscribe, comment. Let that algorithm work for me when this becomes a video. And I hope you guys enjoyed this live stream. Give me a like. And I will talk to you guys next Saturday. Goodbye.